Hi, this is Juliet, a young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so that I can notify you when I have a new video. This is the continuation of part 6 about investments in equity securities and debt securities. I discussed in part 6 about the impairment of available for sale securities. Just click above or the link below this video to watch part 6. In this video, I am going to discuss about investments in associates. Investment in associates. When the shares of stock held by an investor give the investor significant influence over the investee is called an associate. Significant influence is the power to participate in the financial and operating policy decisions of the investee but is not control or joint control over those policies. An associate, however, is not limited to an incorporated entity. It may also include an incorporated entity such as a partnership or a joint venture. The existence of significant influence by an investor is usually evidenced in one or more of the following ways. IAS or PAS number 28, Investments in Associates, paragraph number 7. Letter A, representation in the board of directors or equivalent governing body of the investee. Letter B, participation in policy-making processes, including participation in decision about dividends or other distributions. Letter C, material transactions between the investor and the investee. Letter D, interchange of managerial personnel. Or letter E, provision of essential technical information. The existence of significant influence over the investee may be judgmental, such that IAS or PAS number 28 in paragraph number 6 concludes that if an investee holds directly or indirectly 20% or more of the voting power of the investee, it is presumed that the investor has significant influence unless it can be clearly demonstrated that this is not the case. Conversely, if the investor holds directly or indirectly less than 20% of the voting power of the investee, it is presumed that the investor does not have significant influence unless such influence can be clearly demonstrated. When the investment in associate is not held exclusively for disposal within 12 months from acquisition date, the investment should be accounted for using the equity method, unless the investor is a subsidiary of another entity or the investor's debt or equity and instruments are not traded in a public capital market. The use of the equity method is described as follows. The investment in associate is initially recognized at cost, debit investment in associate, credit cash, or an appropriate account title representing the consideration given. The carrying amount of the investment is increased or decreased to recognize the investor's share of the profit or loss of the investee after the date of acquisition. The investor's share of the profit or loss of the investee is recognized in the investor's profit or loss in the statement of comprehensive income. Debit investment in associate, credit share in profit of associate, share in profits of the associate. Any difference between the cost of the investment and the investor's share of the fair values in net identifiable assets of the associate at the date of the acquisition of the investment is attributable to goodwill. However, goodwill is not separately recognized and is carried in the investment balance. Goodwill is not to be amortized but is subject to annual impairment loss under IFRS or PFRS number 3, Business Combination. Share in impairment loss attributed to goodwill adjusts the investor share in profits and losses. Debit share in profit of associate, credit investment in associate. Share in impairment loss of goodwill. Appropriate adjustments to the investor's share of the profits or losses after acquisition are made to the investment account. For example, for depreciation of the depreciable assets based on their fair values at date of acquisition is debit share in profit of associate, credit investment in associate. Share in depreciable based on fair value allocation of excess. Distributions, dividends received or receivable from an investee reduce the carrying amount of the investment. Debit cash or dividends receivable, credit investment in associate. Changes in the investee's equity that have not been recognized in the investee's profit or loss, such as those arising from revaluation of the property, plant, or equipment, and from foreign exchange translation differences, are considered as adjustment to the carrying amounts of the investment. These changes are recognized in other comprehensive income section of the Statement of Comprehensive Income. Debit investment in associate, credit share in revaluation increase of associate. Share in the associate's recognized revaluation surplus. Illustration. The following transactions were completed by D Corporation involving its investment in E Company during the year 2009. Following the assumed transactions are the journal entries. Purchase 25,000 E Company ordinary shares at 150 pesos each on January 1st, 2009. The shares represent 25% of the voting rights in E Company. The net assets of E Company on this date have carrying value of 14 million pesos. Debit investment in associate 3,750,000 pesos. Credit cash 3,750,000 pesos, which is computed as 25,000 shares times 150. Second, receive cash dividends of 10 pesos per share from E Company. Debit cash for 250,000 pesos. Credit investment in associate 250,000 pesos, computed as 25,000 shares times 10. Number 3, profit reported by E Company for the year 2009 is 2 million pesos. Debit investment in associate 500,000 pesos. Credit share in profit of associate 500,000 pesos, computed as 25% multiplied by 2 million pesos. Number 4, the carrying amount of E's identifiable assets equals their fair values, except for land, which at the date of acquisition of the investment had fair value in excess of carrying amount of 200,000 pesos, and building, which had fair value in excess of carrying amount of 400,000 pesos. On January 1st, 2009, The building has an estimated useful life of 10 years. There is no indication of impairment in goodwill. Debit, share in profit of associate for 10,000 pesos. Credit, investment in associate, 10,000 pesos. The adjustment in income and carrying value of investment is computed as follows. Cost of investment, 3,750,000 pesos. Underlying equity in carrying value of is net assets, 3,500,000 pesos, computed as 25% multiplied by 14 million pesos. Excess of cost, 250,000 pesos. Attributable to land, 50,000 pesos, computed as 25% times 200,000 pesos. Attributable to building, 100,000 pesos, computed as 25% times 400,000 pesos. Goodwill, 100,000 pesos. Applicable adjustment for depreciation on building is 10,000 pesos, which is 100,000 divided by 10 years. There is no adjustment applicable to land, even if it is fair value at the date of acquisition of the investment, differs from its carrying amount in the books of E company, because land is not subject to depreciation or amortization. Neither is there any adjustment on the goodwill, as goodwill is not impaired. If goodwill is evaluated to be impaired, a proportionate share in impairment loss should be taken up by D by debiting income from associate and crediting the investment account. On the face of the statement of financial position, investment in associate should be shown in separate line presentation as required by IAS or PAS number 1, presentation of financial statements. Likewise, income from associate shall be presented as a separate line item on the face of the statement of comprehensive income in the profit or loss section. The investment in associate is measured on the statement of financial position at its carrying amount based on equity method. In our example, the December 31st, 2009 statement of financial position of the corporation should show a balance of 3,990,000 pesos, computed as 3,750,000 less 250,000 plus 500,000 less 10,000 for the investment in associate under the non-current assets classification, and income from associate is reported on the face of the statement of comprehensive income for the year ended December 31st, 2009 in the amount of 490,000, computed as 500,000 less 10,000 pesos. Other issues affecting the investment in associate. Difference in reporting dates. The most recent available financial statements of the associate are used by the investor in applying the equity method. When the reporting dates of the investor and the associate are different, the associate prepares for the use of the investor financial statements as the same date as the financial statements of the investor, unless it is impracticable to do so. Paragraph 24, IAS or PAS number 28. When the financial statement of an associate used in applying the equity method are prepared as of different reporting date from that of the investor, adjustments shall be made for the effects of significant transactions or events that occur between that date and the date of the investor's financial statement. Paragraph 25 or IAS number 28. The maximum difference for the two entities' reporting dates is 3 months. The length of the difference between the two reporting dates shall be the same from period to period. Difference in accounting policies. The investor's financial statements shall be prepared using uniform accounting policies for like transactions and events in similar circumstances. Paragraph number 26. This suggests that the investor will make adjustments for any effects of transactions accounted for by the associate differently, so that the measurement of the investor's income or loss from the associate and of the carrying value of the investment shall conform to the investor's accounting policies. Associate has preference shares. When the associate has outstanding preference shares, the measurement of the investor's share of profit from associate shall be based on the associate's profit after making adjustments for the dividends on preference shares. If an associate has outstanding cumulative preference shares, the profit shall be adjusted by deducting the required preference dividends whether or not declared. If an associate has outstanding non-cumulative preference shares, the associate's profit shall be reduced by the amount of preference dividends declared during the period. Illustration: XYZ Company owns 25% of the ordinary shares of GHI Corporation. All throughout the year 2009, GHI has 8% preference shares with total par value of 10 million pesos. GHI declared 700,000 pesos dividends on its preference shares. GHI reported profit of 3 million during the year 2009. Compute XYZ's equity in the profit of GHI assuming A. The preference shares of GHI are cumulative. Letter B. The preference shares of GHI are non-cumulative. Solution: A. GHI preference shares are cumulative. GHI profit for 2009, 3 million pesos. Preference annual dividends, 800,000 pesos computed as 8% times 10 million. Profit attributable to ordinary shareholders is 2,200,000 pesos. XYZ's equity in GHI times 25%. XYZ's equity in profit of GHI is 550,000 pesos. Letter B. GHI's preference shares are non-cumulative. GHI's profit for 2009, 3 million pesos. Preference dividends declared only 700,000 pesos. Profit attributable to ordinary shareholders is 2,300,000 pesos. XYZ's equity in GHI multiplied by 25%. XYZ's equity in profit of GHI is 575,000 pesos. In case A, the amount of preference dividends deducted from the associate's profit is the annual dividend, whether or not declared. In circumstances that the total amount of dividends includes dividends on prior year on preference shares, only the current annual dividends are to be deducted from the associate's profit to arrive at profit attributable to ordinary shareholders. In case on letter B, the preference dividends are deducted from the associate's profit because such dividends are declared during the year. If no dividends are declared during the current year, no deductions shall be made to the associate's profits. Thank you for watching my video. I hope you learned something from this video. I did part 8 and continuation of this video wherein I discuss in Part 8 about the investment in debt securities. Just click above or the link below this video to watch Part 8. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Yang Orfiano. See you on my next video.